Two people, same age, same education, same salary. One lives in the United States, the other in Singapore. On paper, both are middle class. In reality, one is on a financial trapdoor, the other a slow-moving escalator going up. In the US, your financial life is tied to private markets. Retirement depends on the stock market, healthcare on employment, and housing on credit. Your safety is outsourced to Wall Street. In Singapore, the middle class runs on forced asset accumulation. Every month, money goes straight into your CPF, automatically invested into housing and national assets. In America, housing is an investment vehicle first. In Singapore, it's social stability. The US middle class has more speculative upside, but is exposed to market crashes, job shocks, and healthcare costs all at once. Singapore's middle class has less explosive upside, but far more downside protection. Their wealth grows slowly, structurally, predictably. This is boring. And boring is how the middle class survives. Here's the part nobody likes to talk about. In the United States, a high salary isn't protection, it's exposure. The higher your income, the more disposable you become. Companies don't protect high earners, they cut them first. When layoffs hit, they are fast and brutal. Your six-figure salary disappears instantly. Now, factor in age. In the US, after 45, recruiters stop calling. You're suddenly overqualified. You're not fired for your age, you're optimized out. Compare that with Singapore. Singapore doesn't worship high salaries. It worships employability. Instead of sudden income cliffs, Singapore has re-employment frameworks, wage support, and gradual role adjustments. You don't fall off a cliff at 45, you step down a slope. And that slope still pays into your housing, retirement, and medical coverage. The US middle class is designed for upside. Singapore's is designed for survival. In the United States, healthcare isn't a service, it's a financial stress test. No amount of stock market gains can outrun a hospital invoice. Even with good insurance, one surgery can wipe out years of gains. This risk forces conservative investing. You can't fully commit to equities when you might need emergency cash. So Americans hold cash, underinvest, and sell assets at bad times, making their market-based wealth structurally weaker than it looks. Now let's flip to Singapore. In Singapore, healthcare is not free, but it is contained. Costs are transparent, subsidies scale with income, and insurance is standardized. Medical bills do not ambush your portfolio. This gives Singapore's middle class a massive, underrated advantage. They can stay invested longer. Longer time in the market, with fewer forced exits, compounds into real wealth. Then there's debt, where the US middle class bleeds slowly. American households juggle student loans, credit cards, and medical debt. Debt servicing eats into investable income. Your stock returns are theoretical, your debt interest is real. In Singapore, consumer debt is tightly regulated, education is subsidized, healthcare is capped, and housing debt is long-term. More income flows into assets, not interest payments. In the US, the middle class looks wealthy on paper, but is fragile under pressure. In Singapore, the middle class looks modest, but is hard to knock over. Stocks and real estate only work if you can hold them. Forced selling is the enemy of compounding, and healthcare-driven debt is the most common trigger in the United States. In the next chapter, we are going to hit the most sensitive topic of all: property bubbles, government intervention, and why Singaporeans don't panic sell real estate while Americans are trained to treat housing like a casino. This is where the illusion cracks. In both countries, the middle class believes the same lie: my house will save me. But the systems behind that belief could not be more different. In the United States, housing isn't shelter. It's a speculative asset class. Prices are driven by interest rates and investor demand, not social planning. The result? Middle-class Americans are trained to think like leveraged investors: buy early, borrow big, and assume prices always go up. When they do, the house stops being a home. It becomes an ATM. But then the cycle turns. Interest rates rise, buyers disappear, and the house becomes a fixed-cost liability with no exit. This is why US housing crashes don't just hit prices. They hit families. Now look at Singapore. Singapore doesn't treat housing as a free market experiment. It treats it as infrastructure. Most middle-class families live in government-built apartments that are price-stabilized and policy-managed. These are not luxury units. They are stability machines. The government actively intervenes to prevent speculative boom-bust cycles. That's why Singaporean property markets feel boring. And boring is the point. Families aren't encouraged to gamble their net worth. Instead, they buy at a controlled price, pay using their CPF over decades, and exit into retirement with predictable equity. No panic selling, no foreclosure waves. So here's the uncomfortable comparison. In the US, housing volatility is sold as opportunity. In Singapore, it's treated as a threat. One system privatizes risk and socializes failure. The other socializes stability and limits upside. American homeowners must time the market correctly twice, when they buy and when they sell. Singaporean homeowners don't. Their housing outcomes depend far less on luck and far more on time. And when recessions hit? In the US, housing amplifies fear. In Singapore, it dampens it. In the final chapter, we'll answer the question, if everything goes wrong, which middle class actually survives with dignity? Strip away the brochures, forget GDP rankings and LinkedIn flexing, ask the only question that matters. When the system fails, what happens next? Because failure isn't hypothetical, it's cyclical. Markets crash, companies restructure, growth stalls. This isn't pessimism, it's history. So let's run the stress test. In the United States, the middle class enters a crisis exposed. Retirement is tied to stock markets, healthcare to employment, housing to credit. One shock triggers another. A layoff can lead to insurance loss, medical debt, and forced asset liquidation. You're not poor, but you are fragile. This is why Americans fear recessions, not because they earn less, but because they fall faster. Now look at Singapore. The middle class enters a crisis buffered. Housing is secured through policy, healthcare is capped, and retirement is funded continuously via CPF. When income drops, the system absorbs the shock. Wealth growth slows. It doesn't reverse violently. This isn't about generosity. It's about design. The US assumes upside and prays discipline will save people. Singapore assumes failure and engineers around it. So if markets soar for 20 years, the American middle class wins. More upside, more speculative wealth. But if the next 20 years look like the last 20, volatility, aging populations, lower growth, then upside matters less than survivability. The American middle class is richer in good times. The Singaporean middle class is safer in bad times. One is built for acceleration, the other for endurance. And finance doesn't reward bravery, it rewards staying power. The middle class that can hold assets through downturns beats the one forced to sell at the bottom. And forced selling isn't a personal failure, it's structural. So who is actually safer? The safer middle class is the one whose system doesn't panic when life stops going according to plan. And that is the difference nobody wants to monetize in a thumbnail, because fear sells. But survival compounds.